Ahoj, já jsem Pavel Sopera.
A já jsem Lukáš Zlutervan a tohle je Growcast, podcastový seriál akcelerátorů Meant to Grow, jehož cílem je pomoci vám, zakladatelům technologických startupů, rychle růst a expandovat.
V Growcastu se věnujeme praktickým radám a zkušenostem founderů a expertů na témata, která rychle rostoucí firmy opravdu trápí. Prostě žádné příběhy, ale praxe.
Zdravím vás z podcastového studia Magenta Experience Center a jdeme na to. Welcome to another episode of Growcast. Today's episode is truly special because we've joined by some incredible guests all the way from the UK. At Growcast, one of our core pillars and a cornerstone of Meant to Grow is helping you secure the capital you need to thrive. And that's exactly what we'll be diving into today.
Hi, and my task as always is to introduce our incredible guest. It's James Church. Hi, James.
Hi, nice to be here.
Thank you for coming. James is co-founder and COO of Robot Mascot, and Robot Mascot is a UK leading agency which is helping startups to raise funds, which is, as Lukáš already said, an important part of what we do in Meant to Grow. And Robot Mascot over the past 10 years has worked with more than 100 founders or hundreds of founders, as I learned, and helped them to raise more than 200 million British pounds. So it has some incredible track record in this respect. And James himself is also an author of a book and the methodology which comes out of this incredible experience. And the book for you to read and learn is called Investable Entrepreneur, How to Convince Investors Your Business is One to Back. And you can buy it on Amazon, where, by the way, it was a best-selling book in entrepreneur section. It has been for some time, but one day it oversold even Elon Musk and Bezos and the like. So congratulations!
Thank you.
But anyway, you now understand why James was our pick for today's topic because he's super experienced in the topic on how to raise the funds in startup, and this is what we are going to dive in. And again, James, I already told you before the podcast, but please be as practical as possible in the podcast. We are trying really that every episode will, in an hour, move our startups years ahead. And many of our listeners are either fundraising or planning to fundraise. And your help, practical help and advice would be greatly appreciated.
Absolutely. Yeah.
So we call this episode The Perfect Pitch. But what are the key questions I should address and what groundwork should I lay before diving into creating my pitch deck?
Yeah, great question. And I think this is really, it's really the difference between succeeding in funding and not. We started just doing pitch decks for clients, and we used to claim that our clients were 10 times more successful at raising investment as a result of that, which is good, but we felt we could do better. And it became clear that they might be getting meetings with investors because they had a great and compelling pitch that engaged that investor, but then they weren't able to close the deal because they didn't understand their numbers, they didn't understand their business case to the depth that was needed to really convince an investor to trust that they were someone who could execute on this vision, they could make it a reality. So we kind of took a step back and extended what we offer and kind of go into the business case, the financials, and the pitch. So for me, the pitch is the conclusion of a body of work, which is about defining the business case, how it stacks up commercially, and how you can make money and proving yourself to be a really good entrepreneur, not just someone with an idea. And that's why the book is called Investable Entrepreneur and not Investable Business, because really this is about the layer below the business idea and actually are you capable as a founder to execute on it and convincing an investor of that. So that's the real groundwork.
So what you are basically saying is that it's not about having a nice presentation with slides, but it's a long process and also some strategy behind it. Can we maybe start a little bit even earlier before that? And can you tell us with your experience, what are the parameters of the strategy? I mean, in terms of timing and in terms of to whom do I actually target the pitch to? When should the startup think about it? How the process? How long does it take, and so on?
So I think if you think you might need to raise investment at some point along your journey as a business, you should start building those relationships with investors high net worth individuals, business leaders in your sector as soon as possible before you need their money. We find the clients that raise funding the quickest and raise the most money with the most ease are the ones that have started building a relationship with investors way before they need it. And they'll approach them with a pitch and a business case, but they'll have some key milestones that they need to hit before funding is something that they're seriously considering. So you start that relationship saying, we're here right now, we're heading for here, this next point in our journey. And when we hit that point in our journey, that's when we'll need funding. And what do we need to do to get you on board between now and then?
So you're saying basically warming up the contacts and the investors. How do I do
That's
it in practical terms?
So there's lots of different ways. So we talk about having a multi-channel approach. So if you study marketing at all, you'll know that the best approach to any kind of marketing campaign is a multi-channel approach. So you need multiple routes into investors, like any good marketing campaign, because essentially that's what it is. You've got a product to sell, that's your shares, and your audience is the investor. So you want to be attending industry networking events and meeting business angels in your community, industry leaders, high net worth individuals, people who lead the field. They can either invest themselves at an early stage, or they might be able to introduce you to the sorts of investors you need to be speaking to. You want to be scouring databases like LinkedIn or Crunchbase for investors in your area, or more globally in your space, in your sector, who niche in this and have a real expertise in this. You can be leveraging other startups. So find other startups like you who have in a similar stage of raised money, and get to know those founders and find out who their investors are and get introductions that way. So just really building this multi-channel campaign of kind of direct outreach to investors, networking, building relationships. That's how this game works.
And I understand it's a long-term job, but in terms of like when I really know I need I need the funds, let's say, in May in that year. How long before that I should jump into it? Like really,
that's the
like
$1
in
million
terms of preparation of the assets and everything.
That's the $1 million question, right? How long does it take? And the reality is, like, if you were to Google this or ask ChatGPT, they would probably say 3 to 6 months, because that's the general given. But I believe that 3 to 6 months is from the moment you start pitching to the moment you end up with the cash in the bank. In a really good, if you had a really good kind of experience. I've known clients to raise money in a week. I've known clients to raise money in 12 months. And I would say, like, honestly, you have no idea how long it's going to take, and it will be somewhere between now and then. It was somewhere between a week and a year, which I know isn't very helpful, right? Because, but that's the reality of it. So what you need to do is really, as I say, start building those relationships sooner rather than later. So you have a warmed up audience and that will shave 2 or 3 months of just building relationships. And then when you are getting close to needing the funding, I would say start preparing your assets a good 6 to 12 weeks ahead. It's going to take that long to really get them good and get them to a high enough standard to convince an investor. So you really need to be thinking about this at least 6 months ahead of even starting the process of raising funding. So start building relationships with people 6 months ahead. Start really focusing on nailing those funding assets maybe 3 months ahead. Then you launch your round. And then if you've already built those relationships, it should be quite quick to move to pitching and due diligence. And then it could be anything from a week to a year for investors to sign legal terms, agree all those things. But usually 3 to 6 months.
I like how you compare the whole process to acquiring a client. And I think if you use that, and we look at it from the perspective of the funnel, another question that may come is, how many investors do I need to approach, and how many leads do I need, and what's the healthy conversion rate here? Like, do I need to approach 100, 200, maybe 5 investors? What do you think is the healthy number?
Another stage.
Another great question. So you have, obviously, at an earlier stage, you're going to have to cast the net wider, I think, than a later stage where you're looking at VC funds, where there's less people with that type of capital, that if you were raising big rounds, so it's a much smaller, more niche campaign. But assuming it's sort of fairly early stage funding, it's going to be the trick is getting kind of a fairly wide net while at the same time trying to stay as focused as possible into a field in which they're an expert or have experience. So that can be quite challenging. The rule that we've come up with, and this is a very, very rough ballpark, but we use the 50-10-2-1 rule. So 50 sort of conversations or outreach to 50 investors should hopefully lead to 10 conversations, 10 pitch opportunities, which should lead to 2 expressions of interest. And then one of those expressions of interest is going to fall through and one will end up investing. So 50-10-2-1. Again, depending on stage of development, how progressed you are, how early, how concept stage you are, whether you've got proof of concept traction, whether you've already got revenues, whether you're already generating $1 million in revenue, will change those numbers massively. And it could be 200-1 or it could be 5-1. But as a general rule, I think that rule gets in your head the scale at which you're going to need to at least have meaningful conversations with 50, out to 50 kind of in a network, like introductions and conversations. If you're doing cold outreach and you're kind of contacting like a big list of it, then those numbers are going to be vastly different. We do outreach to 1,000 contacts, you know, for some of our clients. So
would you say this has changed over the past few years? Because of course everybody's trying to raise capital. So I can imagine being an investor, you get dozens and dozens of emails, LinkedIn messages every day. And also, would you say that some channels are more effective than others? Let's say LinkedIn outreach. Is that effective, or should I prioritize meetings, events?
So the first part of the question was, sorry.
It was about. I completely forgot.
No. Well, let's go with the let's go with the LinkedIn, the LinkedIn outreach and which things are best. So we find there's 4 kind of hero strategies, 4 hero tactics. One is warm introductions. Whatever you can do to get a warm introduction, you know, do whatever you can to get a warm introduction to someone on your target list. That's the surefire way to get a meeting. If you can't achieve that, then a cold outreach with some kind of personalized element to it, kind of why you've contacted them, what it is about them and their experience or their previous investments that make you think they might be a right fit for you. That works really well. Obviously, applying to funds and angel groups directly works really well. And leveraging your own network. So a lot of people have hidden investors in their network they had no idea about, or people who can connect them. You know, oh, my uncle is an investor. You'd have no idea unless you put it out there. I'm raising investment. I need help to get connections. And then you find your ex-boss from 10 years ago or someone you met networking 5 years ago happens to be an investor. They've followed your journey and they'd like to have a conversation. We actually had someone who took this sort of offline and they go to church every Sunday and they sat down next to this chap that they've been sitting down with for the last sort of 18 months, having that sort of conversation, and just mentioned that he'd just finished working with us and he was now launching his funding campaign for this startup. And he went, no way, I'm an angel. I have an angel group. Let me introduce you. I had no idea for 18 months he was the perfect guy.
So basically talk about it.
But just talk about it all the time, wherever you are, because people will make connections for you. If you express your vision, this is what we're trying to achieve, and here's our goal, we're trying to raise funding, it will help people make a connection as how they can help you. So those are the things that work. The things we've found less effective are LinkedIn connection requests being one of those things, much lower conversion rate than via email. Probably because it's so easy to find their LinkedIn, it's much harder to know their email. But they will just be completely inundated, and they very rarely accept any connection requests from people they haven't already met because of that. So there's just so much going around that they just can't keep up with the number of connection requests.
So are you saying, because in my point of view, I mean, all the venture capital funds are sort of designed to receive the offers, right?
Yeah.
So do you say, even though even this is the fact that it actually helps to get a warm like a lead in there and recommendation, or
still a warm introduction, because they are built to have inbound leads, and that's the slight difference between angels and funds. They are built to receive an application via their website or whatever, but it's usually a junior or an intern that's kind of assessing those to see if they end up on the desk of the person that makes a decision. So if you can bypass that by having a warm introduction, it's much better to have
come directly to the desk.
Yeah, exactly. Go directly to the people that. So you want to be. So that's where LinkedIn can work. Is more if you've got a particular fund in mind and you want to find who their investment analyst is, for the particular department.
Mm.
But then rather than trying to connect directly with them, it's then who can introduce me to that person would be a much better approach.
Mhm. So basically, you are saying that we should target as many as possible. Is there also an alternative strategy that I will just select 3 and just go much deeper and much more straight to these 3, or because they make some sense for some reason?
I've not really seen that work in my personal experience. It might be different for others, but generally, if you're talking, it may be there's only 3 funds of the right fit, and you're a much later stage investment, and maybe that's the right thing. But certainly at an earlier stage, if you put all your eggs in 1 or 2 baskets, is that a phrase over here? But yeah, so if you put if you do that, you're going to end up where you're at a disadvantage. You want leverage. You want more people interested in you than you have capacity for. So a great campaign will say we're raising, let's say, 500k investment, and I've got to the point of so many conversations with investors that I've got 750k committed. So I'm overfunded, and now I'm an attractive opportunity, and they're all fighting. These investors are fighting, and if someone to be part of this deal, and if someone drops out, no big deal because I'm oversubscribed. If you've only got 2 or 3 people you're talking to, and all bar one ends up dropping out till the very end, it's whatever deal terms they offer, you have to accept or start again. And that puts you in a horrible negotiating position. Whereas if someone's trying to be mean on terms and take as much equity as they possibly can, and you've got other investors who are willing to do a better deal, you can turn them away.
Okay.
So you want to be in a position where you have excess demand, because that gives you it's hard to do, right? But if you can that should be the aim. So then you're in the best possible position to negotiate the deal.
So taking a few steps back, at some point you will need a pitch deck. So what would you say are the 6 principles of the perfect pitch, and why?
Yeah. Okay. So now we're coming on to the core of the book. The 6 principles of the perfect pitch is the methodology we've created, and it's a communication methodology about how to write and communicate with investors. But essentially, the first principle the first 2 principles come into that planning and preparation we talked about. So it's the plan and the projections. What's the business case? How do we articulate that in a clear, concise, compelling way to an investor? How does that translate into a financial model that investors can get behind and see that you really understand the mechanics of your business? Once you've got that preparation in place, you kind of move into the communication phase, where you're then talking about the structure of the content, the content itself, and the clarity of that content. So sort of 3 phases you go through, where you think, what do I actually need to say? What does an investor need to hear? And how do we order this? So this isn't what we say, it's the order in which we say it. We structure the story, the narrative, to put the best foot forward, if you like, shine the best light on this business. Then it's the content. How do we turn this whole business case into slides that are like no more than 50 to 100 words, clear, concise, compelling? And then a final kind of clarity check. Is it with fresh eyes? Does this make sense? Do I understand it from outside the business looking in? Or do I need a master's degree in technical engineering to understand it? And then the final and 6th principle is the design itself.
Yeah.
It needs to look like a multi-million-dollar company. It's got the potential. You are on the path to becoming one of those. And the more professional, the more established you can look, the more likely you're going to grab their attention. And you can use design to draw the eye to key pieces of information and take that, make sure that the investor walks away with at least a summary. Even if they just flick through it, the design should help them take away a very brief summary.
So you mentioned a very important thing, and that is that the content needs to be very condensed. If you were to design a checklist of non-negotiables, what are the key items that need to be present?
Yeah. So when it comes to the information which is contained within a pitch, you're going to need to talk about your vision and value proposition for sure. So we have a 5-act structure we actually use for this. So the first is a hook. That's your big vision. How are you gonna get people to invest their time in this pitch? Then you have
this means what? Like what
the
big
hook
problem I'm solving? Or?
Yeah, so the vision beyond making money. How are we changing the world? How is this going to impact on humanity or the planet or whatever? But how is this bigger than just making money? Then it's the value proposition. What's the problem that we're solving? what's the solution to that problem, and who's the market. Then you've got the evidence, which is now, okay, well, this is the theory. Now, what data do we have to back that up? What research, surveys, focus groups, what evidence do we have that this is something the market wants or needs? If you're a later stage business, this is where you talk about your traction, your validation, how many clients you have, and that the market's adopting the product. Then you move into the fourth act, which is the plan, where you're summarizing the business strategy. Here's how we're going to spend the money in a handful of slides. These are the key strategies we're employing. And then you have the ask, which is here's a financial summary of what this investment will help us achieve in terms of growth and the impact that will have on the P&L. And here's what we're raising and what equity what deal terms at what valuation is all in the ask. So you've got these 5 steps that you want to go through for a content perspective.
That's a perfect structure. Thank you very much for that. And could you be even more specific, let's say, in terms of length of the document and so on? Because you said 50 to 100 words a slide.
Yeah.
Great tip. And how typically your pitch decks look like in terms of length?
Yeah, so there's different pitch decks for different scenarios. So you have your core investor pitch, which would be 15 to 20 slides, no more than that. 50 to 100 words a slide, no more than that. If it's more than that, you're saying too much. And you've got to remember, this pitch is to get them to want to have a meeting with you, to find out more and ask you questions. And that's where you delve into the detail. All the details in your business plan, it's not in your pitch. You then have a teaser pitch, which is best for cold outreach or sending someone ahead of a meeting following a warm introduction to just kind of give them a brief overview. And that primarily focuses on the first 3 acts we talked about: the vision, the value proposition, the evidence, but we don't need to go into the plan and all of those things. That's for later. This is selling in the business as this seems cool. I want to chat to the founder a bit more about this.
Mm-hmm.
Then you have the presentation pitch, which is the same kind of structure, the same number of slides as your investor pitch, but you cut it down, the text down to just a few bullet points, and that's like a backdrop to a physical pitching scenario with where you've got the slides behind you. Then you'll have kind of a few different things, like an expression of interest form would be really useful, or a pitch on a page, a single 1-page version of your pitch to just hand out. If you said, like, you're at church and the bloke next to you is an angel investor, you want to be able to whip out a 1-page pitch that you can hand them. So
it's already the fourth version of the same thing.
Yeah, that's the 4th version of the same thing. And then the final thing is a different thing, but it's the 5th pitch asset I talk about, and that's an expression of interest form. And that's just a very simple form that has them put their name down to express interest in the round. And that's a great step of getting a commitment before the heads of terms. So it's not legally binding, but it's just forcing them to kind of go beyond a verbal, yes, this is interesting, to I'm interested in investing and here's how much I'll contribute to the round. Get them to put it in writing. It feels psychologically more that they've committed to you, even though they haven't. It's just an expression of interest, but they feel more committed to you. And it's also a great way of overcoming objection. So if you think you've had a really great meeting and you ask them to fill in your expression of interest form and they say, no, I don't feel comfortable expressing interest in this round yet, you've seen and found that there's an objection. So now you can say, well, why is that? What do you need to know from me to feel comfortable doing that? And then you can continue the conversation rather than just walking away going, that was a good meeting. You've actually found the reason they're not going to move forward with you. And now you can address it in future meetings. So it's a really key thing. It's a very simple form.
So
really
this
thing.
This is like you always do on the first meeting, that you put this on the
I would, from
table?
meeting one, if you felt the meeting went well, you can just say, look, to better manage our round, we're collecting expressions of interest. It seems like you're interested. Would you be interested in expressing interest at this stage? They can only say no. It's too premature. I'm not ready yet. That's fine. You're expecting them to say no, but you're not saying, will you express interest, expecting to get their expression of interest. You're saying it to draw out the objections. So then you can overcome those and continue the conversation and find out why. And also stop yourself thinking you've got someone who's interested because they're polite, when really they have no interest in investing at all because you're not the right fit for them. But they don't want to say that because they don't want to hurt your feelings, because they're not all mean, these investors. They're humans as well. They don't want you to feel bad about yourself. So yeah, it's just a great way of continuing the conversation and getting those objections.
I think you did a really, really good job kind of describing how this may differ for different stages. Like, for example, including traction once you're later stage. Is there anything particular that stands out for any specific stage, like seed, Series A, that I should be aware of?
Yeah, I think so. So at a seed stage, obviously your plans are going to be much more fluid, shall we say? They're going to be kind of you're still figuring a lot of those things out. So it does rely much more on your credibility as a founder and your vision and your ability to convince someone that you've got a plan. That plan is adaptable. You're the person who can make that plan right as you go along and roll with the punches and do that. Whereas at a Series A, there's much more data. You've already secured some customers. You already know what your acquisition costs are. So you'd expect your plan to be much more focused and a bit more solid. And therefore you can focus on that data a bit more, and it's less about the vision at that point and more about the growth. The other key thing it's worth mentioning here is making sure that you update your positioning and your team as you go. A lot of founders come to us with a brilliant board of advisors and consultants around product, and they go to raise their Series A, and the investors are looking and going, well, you've built the product. We don't really care for these amazing product advisors you have. Where are your growth advisors? Where are your people who can help you get to your first million or go from your first million to your first 10 million? Where are those people in your team? And you've forgotten to update your kind of board of advisors ahead of that next round, and you look ill-equipped for taking that next stage. So it's important that all of these things kind of happen in unison.
Amazing. Thanks for that.
It's a great tips. Thanks. I would like to move to sort of last part of the conversation, and that would be the process itself. Because so far we talked mostly about to whom do I target the pitch, which would probably get me the meeting, and then I'm having the meeting and probably the interest. But how should I manage the process itself? It has some steps, not to end up with. Especially in terms of timing, because in the ideal world, I want to have several term sheets or indicative offers. At one point, I want them comparable and so on. So how do I achieve that? How should I manage the process, and what should I be careful about?
In terms of the actual conversation with investors and managing the investors' expectations.
Yeah, because I have many counterparties. I have, let's say, I have 50 counterparties at the beginning, and then I'm sort of narrowing it down. But at the end, I want to have, 5 term sheets, and I want to be able to select which one is the best for me.
You need to be as organized as you can, tracking each stage of the conversation with each, because they'll all move at their own pace. I think it's really important for you as a founder to take a lead on this, and certainly at an early stage, the VCs are well versed in managing around, and maybe you can, but you want to, you don't want to give them all the control of this. You want to lead with your own timescales and your own, but certainly with angels who many of them are not as experienced as perhaps they'd let on in being involved in, and everyone's got to do their first investment once, right? So chances are you're dealing with someone who maybe you're their first investment. So it's important to understand the process of and control the situation, understand that you need to find a lead investor to really negotiate those terms, and then discover which of those interested parties are willing to be the lead investor. And if none of them are, try and negotiate with them to find one that is willing to negotiate the terms on behalf of everyone else, and who would rather just follow on to those terms. Understanding what legal documents you're going to need to create, but also while investors are doing their due diligence on you, and they're asking you for all this documentation, do your own due diligence on them. When you've got multiple investors interested, which ones can you find out who their portfolio clients are, their portfolio investments are, and talk to those founders about their experience with that individual investor. And some of them will say, we wish we hadn't had that person on board because they've been really disruptive to our process, so I'd avoid them. Or they'll say they're amazing, they give so much help, so much support. Or they'll be like, they gave some money and they leave us alone, and that's great. But at least you'll find out what they're really like versus what they say they'll like. We've got a blog on our website that's like 10 or 20 questions that you should ask investors. So your own due diligence that you should be doing. So yeah, I think you need to start to research kind of and think about what questions should you ask investors to get that due diligence. And I think the more you do that, the more impressive you seem, and it's actually an attractive quality versus a founder who sort of is a bit lost and they're having to do a lot of the guidance. If you can lead on this, be organized.
And in the process, should I state some kind of deadlines until what time I expect the indicative, maybe in the later stages only, indicative offers, term sheets and so on? Because I'm risking losing some of the interested parties potentially. But on the other hand, if I do not do that, the process might sort of get blurred, and so I will not end up.
If you've spent that time kind of while preparing for investment and months before it building that network, you're in quite a strong position to know you've got the people who are interested in the conversations, and they know that at some point when you hit these certain milestones, you'll be looking to raise investment. So it should be no surprise to this network that you've built. So then it's a case of saying, look, we're launching our round in 2 weeks' time. We're doing some preliminary conversations with people that we've already had initial relationships with. Let's book a time, and then try and book as many conversations in a short space of time as possible, and then be very clear in those meetings. This is the timeline. This is when we're looking to close the round. So here, working back from there, here's when we're going to need your firm commitment. Here's when we're going to need an expression of interest from you so we can go through a due diligence process, and just setting those timelines. And if some will say, that timeline doesn't work for me because I have investments tied up over here and that capital's not going to be released until later. Now, if you're in an oversubscribed position and you've built this network, that's fine. You can afford to do that. When you haven't, that's like, I've burnt a bridge and they could be the only person who is interested in me, and now I've blown it because I've given a deadline. So the more that deadline stuff works really well, because anything in sales and marketing with a time-bound deadline to get people over the line is gold. But you can only really do that when you have excess capacity, when you have or excess demand and limited capacity. So you need to really work on getting that demand so you can play that kind of playbook and say, these are the deadlines. If you fit with these deadlines and you're interested, let's rock. If not, we're not the right fit right now.
Thanks for this, James. We try and ask the exact same question every guest on this podcast, and that is if they could recommend any tools, or maybe in your case, lists of investors, anything that you believe could be of help to every founder looking to raise capital.
Well, obviously I'm going to recommend my book and all the resources, but no, if you go to the Robot Mascot website, there's loads of free resources including my book, and that's a good starting point. Outside of our ecosystem, I think if it's lists of investors you're looking for, I think it's tools like LinkedIn and Crunchbase, and using those have been as good as anything else out there, and they're the most easy to access and the most affordable. So I'd go with those sorts of tools. More entrepreneurship stuff in terms of building businesses, I'd recommend reading books by someone called Daniel Priestley. Really good business. He's authored 4 or 5 business books now. They're all great. In particular, if you're looking to build a high growth business, I would look at 24 Assets, his book. It's all about building high value assets in the business, beyond just the business idea, that makes it more sellable, more acquirable, more valuable. So I'd recommend that as a great guide more generally to building a highly valuable business.
Right.
Okay, great. I mean, I learned today that fundraising for a startup is not a piece of cake, and founders should really take care of the whole process, and since very early. Thanks for all the information you gave us, James. It was very helpful and very practical. Thanks
for coming, James.
No, you're very welcome. Thanks for having me.